Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Thank you for everyone that sends in their feedback. Of course, if you can leave a rating wherever you listen to the podcast, I give you a reminder every now and again. That would be wonderful. And if you want to submit a question or feedback or anything like that, just a reminder that email address is questions@investopoly.com.au. All those details are in the show notes anyway. Okay, so let's get on to today's episode. A bit of an interesting one, really. I mean, when you look back at the loan data, so lending data, the average loan size is around 600,000. Now that's the average, which means that, well, maybe not 50%, but there's a large proportion of people that borrow more than 600,000 to invest in property. And in my experience, I would say most people tend to spend somewhere between $500,000 and $1.5 million. I reckon that would represent probably 95% of all investment transactions. Now, of course, there's a few investors. Vast majority of investors only own one investment property, but there's a bunch of investors that own more than one property, and they might accumulate several properties over their lifetime, really, so over a long period of time. So it's entirely possible that, some people listening to this podcast own a couple of investment properties that might be, $1 to $1.5 million each. So I guess in that situation, $3 million of assets invested in the market. And what I'd like to consider in that scenario is, would that person be better off to actually go and buy one asset for $3 million? Or should you spread that budget across two investment assets? Now, if you don't have a multi-million dollar investment budget, don't think that this episode won't be applicable to you. There are some principles here that I think apply really in lots of different price points, but I just wanted to explore what I call jumbo property investing. So that is, can we sort of change or at least test our generally accepted sort of price range for property investment? And if we can test that and maybe move outside our comfort zone a little bit, what are opportunities are presented? And I'm going to share, of course, an example of a client property purchase, which I think is pretty compelling. So before we get into that, however, I just wanted to address a couple of observations. One of my mentors has been a mentor nearly for 20 years. I mean, he's a very wealthy individual and he's built, considerable personal wealth and helped his clients build considerable personal wealth. And in his mind, a budget for an investment property is in the $3 to $5 million range. So maybe 3 to 4 million if it's Melbourne, 5 to 6 if it's Sydney, for instance. And that's his view. And his views have been shaped over many decades. He's in his early 80s now. His views have been influenced by the advice he's given his clients over the last 50 years. And it's hard to argue with those views because they've served his clients really well and they've served him incredibly well. Whereas if I ask the average Australian, what do you think investment property should cost? I reckon most people are going to answer between 5 to 700,000. I reckon that's probably where people, when they initially think I might go and invest in property, that's kind of where they think. So we've got to explore, I guess, why that is. Why do we have, one person that thinks at this scale and the average person thinks at a completely different scale? And I think we're going to, for the sake of this conversation, let's put aside the issue of affordability. Most people, and probably most people listening to this podcast, can't afford to go out tomorrow and go and invest in a $5 million property. I get it, right? And that's not really what I'm necessarily saying you should do. But quite often our approach to financial decisions, and especially decisions like this, are often influenced by many factors. Our upbringing. So, what did our parents sort of teach us about money, if anything? Our own personal experiences and the experiences of our friends and family and anyone that's sort of close to us. And then, of course, the people that we surround ourselves with today. All those, and there's probably many other factors that obviously influence our financial choices, but specifically with respect to, what we think is the right budget for an investment property. And a lot of these things are very arbitrary, right? So not not a lot of them are sort of rooted in fundamentals. A lot of it is really culture, upbringing, and emotion and those sorts of things. So I think it makes sense it certainly makes sense when I speak to that mentor. It really does sort of test my own, for myself personally, and then also for the way that I formulate advice. It tests my own sort of thoughts and beliefs with respect to property investing. And we just want to try and minimize the impact that any limiting beliefs that we might have that might be there for many different sort of emotional or cultural reasons. We want to try and limit their ability or impact on our investment decision making. And from my perspective, and certainly this podcast is a means for that, I really like to test conventional wisdom. Now, I'm not trying to be different just for the sake of being different. We might test conventional wisdom and it might prove to be still the wisest approach, and I'm fine with that. But I don't think we want to fall into a rut and just go, well, an investment property budget is, circa $1 million. That's what it's always been. That's what it's always will be. Doesn't necessarily make a lot of sense. The other observation I wanted to share with you is buyer's agents, or really about buyer's agents, and something I think we need to really think about. Because if we're going to start talking about investment property budgets, who do you go and speak to? Well, I would argue you go and speak to a financial advisor, a property-friendly financial advisor, because they're going to be independent of the actual implementation of that advice. So it's possible that you shouldn't invest in property at all. Maybe there's lots of different reasons why you should set your budget at a particular level. So that's what I think. But most of us, or most people listening, most Australians, would go off and speak to a buyer's agent and go to a buyer's agent and say, look, I've got a budget of $3 million. Should I put it into one asset, or should I buy 2 or 3 different assets? And I think most buyer's agents would reply with the advice to spread it across multiple assets. And I'm not suggesting that in every situation that approach is incorrect. But I think what we have to acknowledge is that most buyer's agents have to target a certain price point. And because they've got to target a certain price point, they've got to kind of make that work from an investment perspective. There's no point starting a buyer's agent business if your specialty is properties north of $3 million, because it's likely you'll starve to death. It's likely there's not enough customers out there for you. Well, there probably is, but it's going to take you too long to build that reputation. Meanwhile, you probably will starve to death. So, of course, then, and particularly in a situation, in an environment where interest rates are high and borrowing capacity is low, buyer's agents need to start accommodating that. Now, some buyer's agents will then compromise also on fundamentals in order to accommodate certain budgets, and you want to be wary of that. So, that old saying, don't ask your barber if you need a haircut. Don't necessarily ask a buyer's agent, especially if their experience lies in a certain price point, whether you should spread that money across various assets or put it into one. So they're just the 2 general observations that I wanted to make before kind of set the scene to now talk about kind of jumbo investing. Obviously that, our views on these sorts of things are shaped by our own experiences and upbringing and culture and so forth. And then, of course, a lot of information that is written that's produced by buyers agents can often reflect, where their comfort zone or experience is, and that won't necessarily help you answer this question. Okay, so let's talk about jumbo investing. I want to talk about kind of the principles first, and then I'm going to as I said, share a specific example that really gave me the idea for the topic of this episode today. So what is jumbo investing? Well, jumbo investing is really trying to maximize your budget and put that budget all into one property to try and achieve a better outcome. And so for those that are listening, I'm going to use a Melbourne example just because obviously I know that market well, but hopefully I'll explain the example in that you don't necessarily need to know the suburbs per se, so you can at least understand the example. So let's say I've got a budget of $4 million. With a budget of $4 million, I could either buy 1 property, 2 or 3, probably, or maybe even 4, but you probably wouldn't do that. So let's think, okay, I still want to buy something that's really high quality. So to my mind, it's $4 million. You could either go and buy, say, 2 single-fronted 2-bedroom terrace houses in, say, Carlton or around that sort of area. A client bought a 2-bedroom terrace, sure it was 2-bedroom terrace, for just under $2 million a few months ago. I think it's a cracker of a property. So you could buy a couple of them, for instance, or you can go and buy a family home. And if I'm going to go buy a family home, I want to buy in an area that really attracts those sorts of potential buyers. So that is that people willing to want to live in a really good quality blue chip suburb that can afford quite an expensive family home. And I think Armadale in Melbourne as a suburb is a good example of that. There are some streets in Armadale that don't have a lot of apartments, that are mostly period large family homes on large blocks. And there's some great streets in Armadale that are like that I think are really attractive to family home occupiers and even people with older families. And according to the census, 2021 census, there's about only 2,200 houses in Armadale, which compared to Melbourne's population of 5 million people, obviously demonstrates it's a scarce asset. Now, if you want a family home in a fantastic suburb, of course, there's other choices around Melbourne. Malvern, for example, could be an option. Brighton, Toorak, they're all good options, okay? We've got 5 million people, only 2,200 houses in Armadale. Now, not every one of those houses are going to be good locations and make good investment properties. So it's going to be, say, fewer than 2,000. Essentially, it's a nice pocket of Melbourne that has really scarce supply, that has some great streets that really accommodate those sorts of properties. Now, the reason I'm explaining this is just so you can kind of paint a picture in your own mind and apply it to the capital city that you might live in if you live in a capital city, of course. And so I'm thinking about, probably a 3, possibly 4-bedroom family home on a block of 400 square meters or larger in a really nice picturesque street that doesn't have a lot of apartments or other types of dwellings in it, and might even have a park in the street, which would be even more perfect, I think. Now, with the push to increase density in our inner suburbs, it's starting to grow, that push, and I think it will only intensify over the coming years. These sorts of assets become more and more scarce because, we know that some properties are sold, apartments are built, or properties are sold and they build some townhouses on it. These family homes in great suburbs, in great streets, on a parcel of land greater than 400 square meters or around that sort of size, they're becoming a scarce asset, and they're only going to become scarcer over time. The other thing, because that block has a certain size, 400 square meters, there's a lot of alternate uses for that property. Someone can come along, subject to approval, and demolish and build a large new home. They could extend the existing dwelling, so sort of build at the back if you like. And depending on planning regulations, particularly down the track, they could develop it into a multi-dwelling site, whether that's apartments or townhouses. But you've got those alternate productive uses with this type of asset. On the other hand, if you think about sort of terrace homes, they tend to have limited potential for enhancing the productive value of that asset. So typically those terrace homes, they're single level residences that occupy most of the block. They tend to build to the perimeter, except for at the rear where they might have a sort of small backyard or outdoor area. And typically the only real option for adding value or increasing the productive value of that asset is to potentially add a second level at the rear of the property. I say the rear of the property because typically they have a heritage street overlay, these properties. And so you might be able to add, say, a 3rd bedroom at the rear, although that can be pretty costly and not always economical in all situations. So therefore, when you compare those two sort of Carlton Terrace houses versus family home in Armadale, when you compare those two options of jumbo investing, by putting in all your money in one asset, you're acquiring a higher quality asset that has more scarcity, and that higher level of scarcity, higher level land value should drive better growth over the long run. And secondly, you're securing an asset that has greater potential for alternate productive uses and will benefit from that trend around density as well, increasing density. Okay, so what I wanted to do next is find some examples in Carlton and Armidale to make my point. The problem is Melbourne hasn't really complied because over the last 27 years, Melbourne's median house growth rate has been 6.4%, which is about 1% below the long-term average. And more recently, over the last 7.5 years, growth has been far more modest, around 2.6%, which is about 0.5% below inflation. So over the last 7.5 years in Melbourne, at least from a median house perspective, property is cheaper in real terms than what it was 7.5 years ago. So it's difficult then to find some examples. I mean, I could find them, but I'd be really cherry picking too much. And to me, that feels like I'm just trying to find the data that supports the hypothesis, and that's not really the approach that I wanted to take. I have shared some research. Actually, it's an article in the AFR, and of course, the link to that article is in the blog on the website, which you can have a look at. And Ray White, economist, Meredith did some research on this and concluded that the most expensive 5% of houses and apartments in Australia have exhibited higher rates of capital growth. So I guess that sort of some anecdotal evidence to some degree. I mean, it's statistical, but I haven't delved deeply into how she did that work. But there is some evidence that shows that those jumbo properties, those more expensive properties, do perform better. Instead, I've taken a different approach. I am going to talk about a transaction that a client completed last year and how that transaction might work out as a jumbo property investment. And this client had a multi-million-dollar budget, and we decided to put that into one asset. So in mid-2023, the client purchased a block of 4 Art Deco apartments in an excellent street in a suburb called Prahran in Melbourne. The land size of this block was 670 square metres, which is really large for Prahran. There are some other blocks that at this size in some streets, but most house blocks in Prahran are less than 300 square metres. So it's great street, a unique parcel of land, if you like. The client purchased the block of 4 apartments for $2.95 million, which was essentially land value. In fact, the bank pretty much valued it. I think they valued the land at 2.9. So they paid $50,000 for the building, if you like. They bought well. Because they used an excellent buyer's agent to help them with that acquisition, of course. And while the building was structurally sound, of course, they got a building and pest inspection before they purchased. The units were in absolute disrepair. I mean, they were in terrible condition, and they required extensive renovation, albeit cosmetic renovation. So new bathrooms, kitchens, plumbing, flooring, painting, these sorts of things. Essentially, the structure was really sound, but any of the fittings certainly need replacing. And when you factor in all costs, stamp duty and renovating, they spent about $500,000 on renovating. They're in this asset for about $3.6 million. So that's their full investment. Of course, that they've borrowed that full investment. Their only contribution to the investment will be funding the holding costs. In terms of income, the apartments all rented out very quickly. The asset generates $144,000 of income annually. And after expenses, including land tax, they expect to net $107,000 from the property, which is a net rental income yield of just under 3%, which is really good for an asset of this size in terms of this value size. Normally, you would expect to see a net yield with a 1 in front of it, 1.5, 1.7, something like that. So they're enjoying that high net yield because obviously they've improved the asset and they've got relatively almost brand new apartments. I mean, it's still an older building, of course, but brand new apartments to rent out, and they're able to get a good income as a result. Now, after taking into account negative gearing, depreciation deductions, because obviously they did the renovations, they can claim depreciation, and interest costs, we anticipate the after-tax of holding this asset will be about $63,000 a year. Now, obviously, if interest rates come down over the next couple of years, that's going to reduce further. But they've invested $3.6 million and it costs them $63,000 to invest in that asset. So that's really their only contribution. Each year they've got to contribute $60,000 towards this investment. Now, if the value of the property appreciates by only 6% over the next 20 years, let's say on average 6% over 20 years, I've calculated that the after-tax internal rate of return is just under 18% per annum. I mean, who doesn't want an after-tax return of 18% per annum? And the reason that the after-tax return is so high is because they've minimized the holding costs associated with the investment. That in relative terms, because 63,000 is a lot of money, but in relative terms, to for an asset to only cost 63,000 on an after-tax basis, to hold a $3.6 million investment is a really good outcome. And essentially, what they're going to do for the next 20 years is contribute $60,000 into this investment. And if they then sell it after 20 years, I project after all costs and paying CGT and tax and so forth, in today's dollars, they'll walk away with $3.7 million. And that's really how property investing works, right? We need to buy an asset that's going to give us the highest average long-term capital growth rate. So one day when we sell it, we walk away with a lot of money in our pocket, and then minimize the holding costs over time to therefore maximize our what's called internal rate of return or percentage return. Now, I wrote a blog a few months ago that suggested that if you had around $3 million of investment assets, that's going to fund a very comfortable retirement for most people, and where longevity isn't a concern. So a perpetual portfolio where the balance of the portfolio continues to appreciate over time. I've projected that it will deliver 3.7 million only after 6% growth in 20 years' time, and that's in today's dollars. So this one asset, even if the client didn't have any other assets, this one asset could fund most people's retirement if they were able to hold it for 20 years, of course. Now, most importantly, this asset does have alternate productive uses. Now, of course, this is always subject to council approval and all the normal caveats and so forth, but there's potential for redevelopment of this asset. There's space at the rear where they could build additional apartments. Someone might decide in the future they want 670 square meters in Prahran and build a large family home, because again, those parcels of land in that location are quite scarce. Alternatively, the client could strata title the apartments and potentially sell them off individually, or by strata titling them, they likely also to potentially maximize the value as well, because the sum of the parts could be greater than the whole in that situation. Probably aren't today just because of where investment grade apartments are, but we all know markets move in cycles and that could be a good way to maximize. They might not need to do any of those things because, as I said, if they get 6%, their returns are going to be great. But if they can get more than 6%, that's going to be really good for them as well. So I thought it was a really perfect example of a jumbo investment where we could have, as an alternative, spread that budget across 2 or 3 different property investment assets, but we chose not to do that. So as I said, the goal of investing in property is to choose an asset that is going to generate a high average capital growth rate over a 10, 20 or 30-year period, over very long term. What the property produces over the next 5 years doesn't matter. It's what is that average? What's the average going to be over that very long period of time? And obviously, to accomplish that, you need to invest in assets that have finite supply or even falling supply that benefit from very high demand, and assets where the buyer, their capacity isn't linked directly to their income, that they've got other sources of wealth as well. And then, of course, assets with low supply and high demand have the greatest likelihood of, say, achieving a 7% benchmark, because I think that's really what we should aim for, is to invest to achieve more than 7% on average over very long periods of time in terms of capital growth. So this brings me to the kind of the first advantage that I want to acknowledge around jumbo investing is that because you have a higher budget, you can afford to invest in significantly higher quality properties. And as a result, that increases the likelihood of achieving more than 7% on average growth over very long periods of time. Putting differently, it reduces your investment risk because you're maximizing the likelihood of achieving your goals. And as I said, it's important to acknowledge that most potential buyers of these types of assets have their financial capacity isn't linked closely to their income. They've got other sources of wealth, could be business, inheritance, these sorts of things. That's a really important point because if income growth is going to be relatively stagnant in Australia, and I think it will be, and borrowing capacity is not going to change, then you really do need to invest in areas where it attracts buyers that do have greater financial capacity. The other main advantage of jumbo property investing is alternate uses. You can, because you're buying a better quality asset, or that quality asset has greater land size, you've got potentially greater alternate uses for that property as well. And that sort of goes back to the example of sort of 2 Carlton Terraces versus 1 family home in Armidale, that sort of example. Now, of course, like everything, like every investment strategy, there's risks as well. So let's talk about those risks. Underperformance is probably your most significant investment risk. And so that can happen, if you mess up the asset selections, you buy the wrong property, or if you end up in a geographical market that underperforms, like Melbourne has over the last 7.5 years. So, of course, we would say use a really great buyer's agent, a talented buyer's agent to minimize the risk of buying the wrong property. And if you've got a long enough time horizon, probably doesn't matter about the geographical market that you invest in, although we've spoken about property cycles and how you can include that consideration when making investments. The cash flow cost of holding a jumbo property investment obviously is considerable. It's not for everyone. Not everyone can afford that. That's obvious. But in that situation, you're going to have greater sensitivity to changes in interest rates and also changes in other things like land tax rates and these sorts of things. So, but if you're conservative with your budget, that risk can also be managed, I think. And finally, there's less flexibility by making a jumbo investment. For example, if it is your only asset, your decision around what you do with that asset is very black and white. You either got to hold it or sell it. It's an all or nothing kind of situation. Whereas if you have multiple assets, at least you do have some flexibility if you get yourself into a situation where you do need to reduce your debt. For example, you could sell one asset and keep all remaining assets. At least you've got that flexibility. So there are pros and cons, like I've said, with everything, with every investment strategy, and we just need to, I guess, be realistic about the risks and potential advantages of jumbo property investing. Now, as I said at the beginning, that's great, but if you don't have a multi-million-dollar budget, does this analysis really apply to your situation? Well, I think it does. And I think there's really 2 important lessons that everyone can take away from this podcast today. The first one is I think it's crucial to reflect on your financial beliefs and any financial beliefs or ideas that have been shaped by your life to date that might be limiting you. And being overly conservative with your budget with respect to, how much you spend on upgrading your home or how much you invest in property. And this is a common observation I find with working with clients. Sometimes we're too conservative and we think being conservative is actually prudent, but actually being conservative gives rise to more risk because then you're going to make some compromises in terms of quality. I would rather, if you're going to do something, do it properly and do it well and try and buy the highest quality asset you can. And by doing that, you maximize the probability of actually achieving good outcomes. So I think that's the first thing is this whole jumbo. If I go back to, the conversations I've had with my mentor over the years, he's really invited me to test my own beliefs around these sorts of things. and that there could be opportunities that I'm missing by being too blinkered about sort of my ideals around what a property budget looks like. And I think the second observation and lesson that people can walk away with is that when it comes to investing in property, it's generally wiser to have one really high quality asset than spreading your budget too thinly across many average quality assets. From a returns perspective, quality is absolutely key, and also from an investment risk perspective as well. So just to wrap up then, if you do have a multi-million dollar investment budget, I think it's absolutely essential you choose your advisor wisely. As the saying goes, to a person with a hammer, everything looks like a nail. If you go to people that have kind of one strategy that accommodates the average budget in Australia, you're not necessarily going to end up with good advice. You need an advisor that has a really deep understanding of both property and shares, and they have the experience to evaluate a wide range of property investment options, and considering various price points and different geographical locations. And they should be able to create a strategy just for you. And that could include considering jumbo property investment. At least it should be one of the tools in their arsenal. Okay, again, another long one this week, so I apologise for that. I promise to get into more Q&A and try and really bang out a lot of answers to your questions. But if you do have any more questions, feel free to send them to me at questions@investopoly.com.au. And until next week, bye for now.